Right, so this is, I've got about 50 slides, so, but I will rattle through them because it's assumed that most of you know quite a lot about technical analysis, so that makes my job a little bit easier. A little bit about me. I actually am Australian. I was born on the Mornington Peninsula. I've been in the UK a long time, so I've lost the accent, but I came here to university and I've still got an Australian passport, don't have a British passport, so I still consider myself to be very much Australian. So I did actually speak at the APTA conference in Sydney, well, it was probably 12, 15 years ago now, on cloud charts and point and figure. So I've been doing technical analysis for 30 years. I've got MSc. I've got the STA qualification and also the MFTA qualification from IFTA, a member of the STA, IFTA obviously, and the American Association of Professional Technical Analysts, because I spent quite a bit of time in the US. We have a US subsidiary company. I teach the STA diploma at the LSE, not on point and figure. I do that on cloud charts. And I noticed that you've got the home study course, and that's one of the modules in the home study course that I give. And I do a lot of this sort of speaking more and more on Zoom with COVID-19. And I wrote the book on cloud charts, and I've written other books and things. And I've given this course, well, I've given courses on technical analysis, mostly to institutions. That's where I spend most of my time. So I'm going to basically just look at the theory and the construction. I'm going to whiz through it. The interpretation of the charts and how the targets work, because that's the thing that most people want to know. We'll look at some differences between the different types of point and figure chart. And then I'll just look at some markets live so we can actually just see where we are now and what the point and figure charts are telling us. In line with your disclaimer, this is just interesting charts. I'm not really making any recommendations. What I won't cover, and that's probably more important actually, is I won't go through all the history and the theory. I won't cover one box charts, some of the patterns and horizontal targets, market breadth, and some of the more advanced techniques. It's just impossible to do the subject full justice in the time. I mean, the book, the definitive book, is by Jeremy Duplessis. I worked with Jeremy for 15 years. We bought Jeremy's company Indexia back in around 2000, and he is the world leading expert on point and figure. So I always say to people, if you really want to understand point and figure, you need to read this book. It's about 600-700 pages long. I helped him edit it, which gave me a great understanding of the subject, but the book is really what you need. So here's a point and figure chart, and the thing that throws most people on point and figure chart is, of course, a very old technique, is that there's no time axis, and the axis is reversals. So for a lot of people, they struggle with that concept that there's no time axis across the chart. So each time you get a reversal in price, you move to a new column. So and it's quite good in a way, because if price does nothing, the chart does nothing. So it reflects change. And I'm guilty of this myself. When I first started doing technical analysis in the 80s, I was looking at all the different charts, and I looked at the point and figure chart and thought, no, I'm not going to use those. They're just too, I don't really get them. And if I could change anything in technical analysis, I wish I could change that. Basically, I really do implore you, it's never too late to start using these. They're very, very powerful. So the main features are typically, they're shown as X's and zeros. So basically X's are up and zeros are down. There's no time scale on the X-axis as we've just talked about. And an X or a naught is one price interval, and that's what we call the box size. There are 1 or 3 box charts, but 3 are the most common, and I think actually the most valuable and probably the easiest to interpret and understand. The 3 box chart comes with an asymmetric filter, so you move 1 box with the trend, and it takes 3 boxes to actually reverse the trend and change columns. So it favors the trend just by the nature of its construction, and that leads to objective trends and targets. They're developed over 100 years ago, and really this was a brilliant shorthand. You know, when the ticker tape was coming out, and there was no real way of recording all the prices because you just couldn't keep up, and there were no computers or anything. Basically, you just would write down the numbers each time you breached a level. So you can imagine, you know, you had $13 and then you went to $14 when it had a 14 in front of it, and people became very familiar with the round dollar mark. So when you went above a level, that was significant, and they'd wait on the 3-box charts. You'd wait until you'd reversed 3 levels. So when you went from 16 and you saw a 12 in front, you'd then write all those in and start a new column down. Otherwise, they would have been just changing column all the time, and this was their way of keeping it's shorthand. They could write this on the back of a cigarette packet or whatever. And then they realized, actually, instead of writing all the numbers down, we could just put a grid and then just do it as noughts and crosses. So this shorthand became a way of filtering the price information in the market. So it became really interesting. And the different construction methods, there's lots of them, but the 3 boxes, as I said, is the most popular. Tick is the original method. You only need to see that 16 once on the ticker tape, and that was enough for you to put the 16 in. But tick data and people who run point and figure charts, so a lot of clients in America have been keeping up these chart books forever with tick data. You know, some people are fastidious about the fact that it needs to be tick data, but we generally don't have great big long histories of tick data. It's just nowadays just too much data. So 1 minute and 60 minute and daily data is fine, and you can use close or high low, and there's various ways around that. But on the whole, I use 3-box daily, 60 minute and 1 minute charts, and that's what I'm going to really focus on today. So this is a 1-box chart versus a 3-box chart. They look quite different, but it just shows the difference here. And I've marked the years on the chart here, so that's last year. And we can see on the 1-box chart, the reversals occur more frequently because you're only reversing by 1 box. And if you do the same with high-low charts, this is a closed chart, that's a year. And if you use a high-low, you can reverse more frequently again because you've got the intraday high and low movements to use to record those boxes. I just use closed charts, but you can use high-low. So the normal TA principles apply. Resistance and support are really important. All the Dow theory, that's you use that on the charts. And you can draw trend lines on manually, but we'll come to see that the 45-degree lines are really, really key. The signals with point and figure are what we call a double top buy, which is a breakout, or a double bottom sell, which is a breakdown. And these are often part of a bigger pattern. But those are the signals. And that's a little, so these are triple top breakouts. And it's just a little bit confusing terminology because, and when I teach this, I always explain that double tops and triple top patterns are different. So we differentiate this by calling it a double top buy signal, a double bottom sell signal, rather than the double tops and triple tops that we're all used to in technical analysis. So for newcomers, that can be quite confusing. The point and figure breakouts, the significance is that you have to reverse by 3 boxes and you have to then break out by a further 1 box. So as we're finding, I mean, I'm sure many of you find you get the price breaking resistance, but it doesn't hold it. I quite often use the 3-bar rule where I want to see it hold it for 3 bars before I'd say it's a proper breakout. But the point and figure construction of the extra box means that actually is really a proper breakout because it's gone further than the previous high, and the same with the low. So it's just that time conundrum, and if the box breaks by 1 box, then that's significant. The signals are unambiguous. The longer they've gone, so the longer you've looked at support and resistance being broken, the stronger. We always look left on the chart for support and resistance levels. And remembering, because the chart is not time-based, those levels could have been set a very long time ago. So, you always look back to see where those levels are and if it's part of a bigger pattern. And we use the trend lines to accept or reject signals. And I will come to that when we look at the 45-degree lines. Just understanding the idea of box size, this is quite an old chart. This is the FTSE 100 index. And if you imagine using a 25/3 box size, you then need 75-point reversals. And so there's lots of 75-point reversals. If you use a 50/3 chart, you get fewer 150-point reversals. And if you used a 100/3 chart, that actually only happens every few years. That's a 300-point reversal. So this one would be 3 columns. This one would be about 7 or 8 columns. This one probably double that. So the more sensitive your box size, the more information you're going to see in the chart. So the box size becomes there's no time scale, but there is time horizon in the chart by altering the box size. And I use this multiple time frame analysis chart that I used actually for my cloud charts book, but it applies to point and figure as well. So I think again in our subject, it's a very common problem that people are not looking at the right time frame chart for the time frame that they're envisaging. It's I see it all the time when I go to traders at their desks. They'll be looking at a daily chart, making decisions today based on what the daily chart's doing. And I'm saying, that point on the end of the chart is actually effectively wrong. It's only becomes right at the end of today when it matches all the other candles. So I always say that days means weeks. A daily chart, you're thinking weeks ahead. A 60-minute chart, you're thinking days ahead. And 5 or 10 minutes, you're thinking hours. And 1 minute, you're thinking about what's going to happen right now. So, and equally on the other side, weekly charts, we're thinking months ahead, and monthly charts, we're thinking years ahead. And even quarterly charts, I still do occasionally look at those for very long-term trends. So the point and figure box size, roughly speaking, this medium term sits between roughly 1.5% of the price. We'll come to see that when we do that. By the way, I don't use weekly charts because daily is effectively the point and figure. The box is the filter, so there's no point in throwing data away intra-week. We might as well use the daily and just increase the box size. And again, tick data is too hard to come by and for a lot of things, so I use 1 minute data. And I use hourly instead of 1 minute data because there tends to be more hourly data available than there is 1 minute. But you could use a 1 minute chart and use a very big box size, and that would be more accurate than the 60-minute chart. But the problem is there isn't really generally enough 60-minute data. Sorry, not enough 1 minute data. So here, just to give you an idea of the different time frames, this is a 1%, or this is 1% of the price. This is 0.5% of the price, so we start to see more things emerging. This is 0.25% of the price, so we start to see more columns emerging. And this is 0.1% of the price, and now we get lots of information emerging. So the changing that box size leads to a lot more. And so these are the years marked here and here, and then you don't really see any years. And of course, we're now really seeing a lot more data. So smaller boxes show more data, and that's something you get to play with quite a lot. So another, just a small point, I work a lot in energy markets with a lot of energy clients, and futures contracts, when they jump, you need to roll these contracts. So you need to roll the price. Otherwise, you'll have a point and figure chart that gives you targets that are not real. We never actually traded that gap. So you need to roll your futures charts just if you're using point and figure. And to be honest, most technical analysis techniques, you didn't need to do that. It didn't trade that area, and traders often have a struggle with that, they say, but the previous contract traded at these levels, but we're more concerned about having continuous data in our charts. So the main things to do with a point and figure chart is to start with the daily 1% arithmetic. So arithmetic chart is where you're using a rule of thumb. So if you had something like, I don't know, something's $100, you would then use a $1 chart. If it was $50, you'd use a 50-cent box size. Then look up one size and down one, and we'll do this when we start looking at some and then you zoom into intraday and the very short term. And so it's that having that discipline of starting longer term, thinking about what the longer term picture is, and then drilling down into the short term is really important. And as I said, I don't really use one box charts. I mostly use vertical counts, and Updata does it. You just press the T key and it puts all the trends and targets on. So looking to the 45-degree trends, it basically is a concept of 5 steps forward, 3 steps back. And the Fibonacci and Elliott aficionados amongst you will recognize immediately the significance of 5 and 3. But 5 steps forward, 3 steps back defines the 45-degree line, because that's 2 boxes effectively. So it's 5. So in order to have an uptrend, you need to be going at least 5 steps forward, 3 steps back, at least. And most uptrends are doing better than that. And the same applies in a downtrend. And so you draw the line from an extreme point, and those 45-degree lines are what define the trend. And I must stress it's from an extreme point. It's not always necessarily from a high-low. So it is that extreme point that defines the 45-degree lines. 45-degree trend lines are unique to point and figure 3-box charts. They're great because they define the trend as soon as you reverse, as soon as you break this line, you can then draw this line. So the trend is defined from the low point as soon as the previous trend was broken. And you may not even have any information yet to build a trend on a line chart or on a candlestick chart, but on a point and figure chart, you're in a position to define the trend from the low point. And of course, one of the problems with trends is by the time everybody can see the trend is probably coming to near an end. So the beauty of defining the point and figure chart trend early is you know that you're in a new trend, and that line defines your trend. And it defines the bullish and bearish state of the chart, and you can draw these internal lines, which I do. And we use the trend lines to accept and reject the double top or the double bottom buy or sell signals. So that's another significant factor with point and figure charts, is you can use the trends to reject the signals. So one of the problems, and I'm always asked about this, in fact, I was asked about this, I was giving a webinar on Friday to 300 or 400 energy traders in Europe, and I was asked about, do you ever use indicators? And the problem with indicators in a downtrend is that they'll keep telling you you're oversold, and so they'll keep telling you it's oversold, but really what you want in a downtrend is to be told it's overbought. And in an uptrend, the indicators will keep telling you it's overbought, but what you really want to be told is it's oversold. So there's a skew with a trend. The beauty of this is you get more sell signals in a downtrend and more buy signals in an uptrend, and you ignore the counter trend signals. So there are fewer counter trend signals and you ignore them anyway. So this trend is your friend. And below this trend, we're bearish. Above this line here, we're bullish. Below this line here, we're bearish. We're into a new trend, we're bullish. So I use log scale quite a lot. In fact, I use it most of the time. It's very long, for very long-term charts, it's obviously necessary. Where prices have moved dramatically, it's also very necessary, or both. But most of all, for me, it normalizes what you're looking at. So you'll compare, whenever you're looking at charts, you're looking at the same box frames, and it saves just having irregular charts, and it's great for trackers, and I'll show you that when I come to do some live analysis for you. So this is the gold price. In fact, I remember at the APTA conference when I did speak saying I was very positive about gold. And of course, that's the arithmetic scale, and that's the log scale, and it's just a completely different looking chart. So here you'd be thinking it's going into a new downtrend, but here maybe it's looking more like a long-term re-rating. Of course, since March, we have actually gone higher on gold. And I'm a big gold fan at the moment, so we'll take a look at gold. So log scale charts, I'm using 1%, 0.5%, 0.25% and 0.1%. And those give me my views. I've resisted the temptation to put the targets on here because I haven't got to how the targets are calculated yet. So the key points are not every signal should be taken. Always look left for resistance and support, and maybe some tolerance on breaches. So look for sloping bottoms and sloping tops, and think about lines with congestion. And always draw the trend lines on a point and figure chart. The trend breaks change, and look for new signals. And signals with trend are much, much more reliable. So that's just the key points. Always think about the trend when you're looking at the signals. Now, I always say to people, I give this as a course. And by the way, I do have an online course. This is a subset of that course. So if anyone wants to do the course, I'll give my email at the end. And I'm happy to put you on the course so you can do it more at your leisure and pause and stop it and really get your head around it. And I accept it's a thing where you kind of, some of you are already probably saying, do you know what, it's great, but I don't think I'm ever going to use it. And I'd just say to you, don't make that mistake. I made that, and I wish, now I have these, it's just so valuable to me. And I'd accept that you would say to me at this stage, David, it's great, but I really just don't think I'm going to use this. But for the fact, when we get to the targets, the price targets are gold dust. And, it's a rules-based system. It was developed decades ago. It's a rules-based system, and it works. We've done lots of back tests on it, and it's a very, very reliable thing. And for us as technicians, that ability to be able to say the price is going to this level, and it's not an Elliott thing or drawing patterns or drawing levels of resistance and support or Fibonacci retracements. It's basically you push a key and it tells you. It's because it's rules based, and so it's a very objective way of arriving at targets. Whereas a lot of other techniques are very subjective and you can easily challenge. I mean, I've seen two Elliott wave people arguing about where the wave count is and where the price is, and with point and figure, it's there. It's not debatable. So the rules are that for projecting vertical targets, there's three ways to do it. One is a thrust off a low, and that is 90% of the time, 95% of the time, probably that is the rule. The second one is a thrust off a low with the first move is very small, and I call that a nested move. So you just had a little reversal and then you get the break. You'd see that very rarely, 1% of the time, or a breakout column where you've been in a pattern, might be a triangle, you've hit resistance, and then suddenly you get a column that's breaking out. You can count that as well. I say here nearly always rule one. This is one of the most valuable slides. I love this. So this is what many traders would call a setup. And vertical counts are about thrust. So the idea, and it's to do with the three-box construction. I mean, that's where it came from originally. So the idea is you come down here, then you rise and you hit you're coming off a low. That's your first initial buying thrust. It's what we call an uninterrupted buying thrust. We don't step back by three boxes there. So we go all the way without stepping back. And the bigger this first move off the bottom is, the bigger the overall potential of the chart. And if I'm doing a presentation live, it depends whether I'm in a cricketing nation, but it doesn't really work in the US. You have to talk about baseball. But if you imagine you've got a cricket ball and you're at the far outer edge of the ground, to throw that cricket ball to the wicket keeper, you have to basically pull your arm so far back that you can actually throw that ball all the way to the center of the ground. If you are, 20 meters away, you don't even have to pull your arm back much. You just can throw it, almost flick it. So it's all about that thrust. So if that first initial wave or that first initial buying thrust is big, that's going to govern the overall potential of the next move. So then what we need to lock that thrust is a step back of the minimum of three boxes. And then we need to break out by a minimum of one box. So when we step back, that that column is locked. That gives us the potential, and the potential is actually another 2 times that first move. So it's 3 times. And I slightly resolve this because most patterns are about the move out of the pattern is equal to the height of the pattern or the move into the pattern. So it's normally about 2 times. But generally speaking, markets will undershoot or they'll overshoot. And I say 3 times is like an overshoot. So if you've got a really big initial thrust, then you're probably going to get overshoot that sort of another 50%. So this is the setup. Once we've broken one box, the target is activated. These bulls here have been confirmed. These bears are now not, they're wrong. The bulls are confirmed. And with that initial buying thrust, this is the resultant thrust, and this might be your 45-degree trend. So the rule is it's the first move is 1/3 of the overall potential of the rise. So rule 1, this is the thrust off a low. So these are all thrusts off lows. So here, this is Brent crude, crude oil. So thrust off a low, another thrust off a low, another thrust off a low, and these are generating all the targets. So over 90% of targets. So that. The second one is there was a low here, but we didn't, the initial moves weren't very big, and then there's a very clear, it's a bit like a breakout column. These are unusual, but you could use that. That one is a really good thrust column off a low, so that's a really good one. And this initial one here is also one on the old rule, but that's if the first column is not big. And this is a breakout. So here you've had 2 attempts to break a level and you haven't, and then you've broken it, and that's a breakout. The idea behind it is any column that significantly changes the chart, and that doesn't give you license to go and do every single column, but here you would do that column. Here, that's a thrust off a low. But this one is questionable because that was quite a big move to begin with, and then not a very big move, so you probably wouldn't use that. It just comes down to experience. You've just got to do it. So activation is when we then move above the top of the column where the target was given. So we've got to pull back, and then we're going to go higher. And negation, and this is something is not often talked about, is where you move back below the level at which the thrust was given. If you move back below that level, all bets are off. The bulls were wrong. And so that column, that target comes off the chart. It's negated. And activation is essential. If you don't actually move higher and activate the column, you could be just at resistance. And so the target is not clear. So this is a UK gas contract. It doesn't really matter what it is. Where a lot of charts are in this position where you've got a target to the upside, a target to the downside, but we're now waiting for the move. And this is you're potentially range bound in resistance and support, and we're waiting for the break in either direction to confirm which move. And one will then be activated and the other one will be then negated. And so the picture becomes clear. We always have to wait for the break. The idea of targets also is clustering. So if you get multiple targets to the same sorts of level, this was on WTI crude oil, you get targets to the same level, that was a cluster. So in fact, back in February this year, one of my calls was that that crude oil would plummet. This was really before the virus was breaking. This was 27th of February. It really wasn't, it wasn't hitting markets. But the targets were telling us that it would plummet. And of course, we had that famous point where WTI crude went negative at the close of the contract. But we did dramatically fall into the 30s and then into the 20s, and the targets were there. And a lot of people in the US who were following me on one of the channels I do there said to me, how did you know that? And I didn't know that. The chart knew that. It wasn't me, it was the chart. Upside targets met and exceeded. So if targets are being exceeded, that's really bullish because you're going even further than the price projection. So that's bullish confirmation to the upside. If they're not met, then you're not quite getting there. You're getting exhausted before you get there. That's bearish. And on the downside, if a downside target is met or exceeded, that's bearish. And if you're not quite getting there, that's inherently bullish. So the levels at which you meet these targets is also really important. So downside targets here being exceeded. So when this target here, this was crude, when it did fall here to $48 and below, it's telling you all the time, all the way down here, it's actually worse than the targets are saying, so it's bearish. Upside targets not reached is slightly bearish, and downside targets not reached is slightly bearish. So we got to a downside target. This was for the British pound. We didn't quite get there. We still had this big thrust column. We didn't quite get there, but then we've changed trend, and you're now starting to look at these new targets and saying the fact that we didn't get to that target is telling us something. So there's lots of telltales in these charts. You do need, it does take experience, and I do really recommend again that you read Jeremy Duplessis' book to fully understand the nature of the charts. You can, if you've got an uncompleted column, you can cheat and put a target on. I just hit the V key and up there and put a target on. But because that column it's a daily chart, it's a 1 minute chart, so I know these have closed out. So that's as bad as it could get. It could get worse. I might get a reversal, but I already have an idea. It's cheating really, but I already have an idea of where the price could go based on the current column. So just projecting before the column locks. So when you get a chart where you see all your point and figure over here, and you've got all this, and you've got all these dramatic moves, there's too many columns. The box size is too small. This is a 1 minute. It's a 60-minute chart. This is actually carbon emissions. So look at greater than 60 minutes or log scale. So this is then a 60-minute with a bigger box size. So I've gone for a bigger, and then there's not enough data here to really get a picture. So I need to look at greater than 60 minutes again. And so now I'm looking at a 60-minute with a smaller box size. So you've got to play around a little bit with these charts, and we'll do that. Now, we'll do some live charts. You've got to play around with these charts a little bit to actually get the chart to be meaningful quite often. And the same with long-term charts. You may have to go to very long-term charts when there are no other targets. So quite often you will find you just can't get targets. And so this is over many years a daily chart of crude oil. Or to very short-term charts, they may have sudden moves, and it might be necessary. So a lot of long-term investors would say, well, I'd never look at a short-term chart. But if the market's breaking key levels, you do maybe want to go in and start looking at those short-term charts to understand whether that's having an impact on your long-term levels, because you'll get a heads up as to whether your levels are going to break. So you do need to do that. So the key factors on targets are that targets have no time scale. The nearest targets must be achieved first. Look out for when they cluster, so multiple targets. Know when the count target is activated or negated, and you often do have opposing targets. We do have a way of resolving that with the trend, but it's recognizing that you do have opposing targets, and it's keeping an eye out for which one is actually going to get activated, and that you then look to take the targets with the trend. And sometimes you get improbable targets, so that's quite key as well. And look for how well they've worked in the past. You can use technical analysis techniques on point and figure charts. Jeremy wrote a subsequent book on this, and it's you use the column reversals as your period. So this is a 20 column Bollinger Band 2 standard deviation chart. I mentioned that we're doing lots of backtesting. There's a lot of backtesting techniques in Updata, and we've got quite a lot of these strategies built in, and we're seeing that the point and figure strategies are really quite nice. This is your equity curve, and you can basically, these are using moving averages on point and figure charts. I use them with cloud charts as well, so we'll see in a minute. I mean, I look at, I've looked at well over 1 million charts, and people say to me, that's impossible, you can't have. I look at probably 1,000 charts a day, and you'll see how I do that in a minute. And I typically have 6 charts, a weekly, a daily, and a 60-minute chart. That's my long-term, medium, and short-term view. and then I have the 1% point and figure, 0.5% point and figure, and 0.1% point and figure. And so this is my view of the market at a glance, and I do rattle through these. If anyone ever sees my charts today video, I haven't recorded this morning because I actually had a problem with my internet connection, which I was rather dreading. So I will record it immediately after this, but I'll give you a heads up as to where you can watch those. So then this is my energy screen, which I watch a lot for clients. So I've got a daily, so I'm going shorter term. I've got a daily, a 60 minute, a 60 minute, and a 1 minute. So that's what I look at. So we've got to the end of the presentation, and I'll now go to doing some live analysis. So point and figure summary points are that the box size and the time interval for time horizon. I use the horizontal and the 45 trend lines to reject or accept signals. The targets must be activated, and that non-achievement or achievement is quite important. And remember that targets are potential and approximate, so you can't hang your hat on them. Sometimes you can. And if they're clustering and you've got multiple targets, that's really key. And we'll see this all in a minute. And you cannot always get a valid target. So I should say that I did have my details at the end. Oh, yeah, so I did have details at the end. So if you, I'll come back to this, but basically I'm on Twitter, I'm on LinkedIn, I'm putting a lot of stuff out, and so you can follow me in lots of different places. Chartstoday.com, I record every day, and I'm using a lot of point and figure charts there, and that's on YouTube. And you can email me, and if you want to take this full point and figure module of our course, then just email me at ta@updata.co.uk, and I'll get the guys at Updata to put you on the course. So this is my screen. I'm running Updata Analytics on a lot of different data sources. So it runs on dozens of data sources. It runs on free data from Yahoo, lots of different data sources. But I use Thomson Reuters Icon. It's now called Refinitiv Icon. And also that's the same as Metastock. So anyone who's using Metastock, this Updata sits totally fine on Metastock, and we've got a very good working relationship with Metastock in the US. So this is my screen. So here's the dollar index, and these are tracker charts. So I basically move up and down the screen, and they just all change. So this is basically a weekly chart, a daily chart, and a 60-minute chart. So short term I'm bearish on the dollar, medium term I'm bearish, and long term I'm bearish, because on the cloud charts I'm below the clouds. So I could use the point and figure trends, and that's a little bit tricky because I can't quite see them. So I'm just going to move myself away from the screen. Okay, we're at the bottom of the screen now. It's a bit better. So these are the point and figure charts. So it's a 1%, a 0.5%, and a 0.1%. So this is the dollar index. And I can take this chart and I can see that whilst the dollar has been bearish on those other charts, the very long-term picture is one of two very, very big targets. We've got a downside target, and this is 1%. So we've only been pulling back this year to the trend. So it's very interesting to think that the dollar might look bearish here, and it's been really falling away, but on the point and figure chart, it's just been pulling back to the trend. So on the very long-term chart, it's still bullish. On the 0.5% chart, we've now got a little bit more data. Notice how these downside targets given way back in 2010 were met. We've got this upside target 20% higher. We are on a downtrend here. We did reach that target that was given, and that was given in around March time. So we did reach that target. So that is bearish confirmation. So we've got a very conflicting picture. Again, notice we had an upside target here to 102. That was given at 85 and then met. That's a big move in the dollar. That was around 2014. And then the very short term, this is what's happening to the dollar now, this week, this coming few weeks maybe. And here we see we've got a downside target that's activated, but it's counter trend. We've got this upside target. So if we moved above 95, let's say, on the dollar index, suddenly the US dollar is back in business and we're going much higher. And we've got percentages to the targets there as well. So I'll look at the Aussie dollar. Actually, most of my investments in Aussie gold shares. So I shouldn't say where I'm invested in, but I'm very bullish on gold long term, and we'll look at gold. And so I do actually watch the Aussie dollar sterling rate quite a bit, and sterling's having a bit of a better time against the Aussie dollar, but here we see this is sterling was as much as 208. It's now back to got as low as 175, and I've got this 165 target here. The long-term chart has now changed. Short term, we are just seeing a little bit of a resurgence in sterling, so that's quite key. Looking at the markets. In fact, what I should probably do first off is just open a chart. So why don't I do gold? So if I just show you the process of putting a gold chart on, so it's XAU equals. So just here's a chart, a daily chart of gold from cold, if you like. So the first thing I do is I just hit the T key and it puts all the trends and targets on. So this is actually a 20 by 3, and that's not really an ideal box size because you'd probably use 25 or 10, but it's not bad. So what I do then is I probably will go up a box size just to get, that's the 25 by 3 chart. I've got a target to 3,200, 2,300, 3,200 if we break the previous high that we recently saw. So that's a massive move, isn't it? 67% higher. If I go to a 50 by 3, I've got 4,000 and that's activated. And if I go to, well, I then don't go much beyond that, but 50 by 3, 4,000 is quite a big chart. So then I go smaller. So I'm just changing the box sizes here. So this is now 15 by 3. I ignore that because that's not a useful box size. I want the round numbers. I want 10, 5. I want the key levels to be in my box size. 2,800. So notice how we were given a target to 2,060 back at 1660, and that was met. So that really gives us some information that that gold, basically is bullish because it met that target. We've got this new upside target. Right now, we have actually activated the downside target. It is counter trend. I wouldn't be surprised to see a pullback in gold, but I would expect it to be not to that level because it will exhaust itself because of the idea that the counter trend targets, you probably won't reach that level. But for the moment, we are seeing a bit of a pullback. Go to new highs, of course, and that is very exciting for the gold bulls. And you go smaller still to the 5 by 3, and you'll notice now that the chart is starting to get a little bit tricky. So what I would do is I'd swap to a 60-minute chart because there's just, the column lengths are now getting a bit hard to read. So I swap to a 60-minute chart, and now I've got a new picture. And so right now, my short-term target on gold in the coming days, week or so, is 1980. Notice how we had that downside target and we didn't quite get to it here. So that's also just some bullish confirmation and we're in a new uptrend on gold. That's a 3 by 3. Probably would go to the 1 by 3. And again, we've got upside targets here, 1948, 1960. So I'm getting some levels that I can think about. Now, all that time, I was actually using arithmetic scales. So I was actually using round dollars, but now I'm going to go to percentage. So I'll go back to a daily chart. This is, and then I press the T key again. So this is a 1% chart, and I prefer to use these because it's a log scale, and it basically just is a little bit easier to use. So then if I go up a scale to, I have to go right up. I'll probably go to 2%, 2,700. Notice this target was given way back here, was eventually met. And if I go to 2.5%, you can get some very exciting targets. 2,900 coming back again. And we can go even bigger. I'm probably going to go to around 5%. I'm having to step up. It's unusual that you go to these levels. Now, then you've got 2,800, that's near that 2,900. This upside target to 11,700 has been activated. Now, that is what we would call an improbable target. And the one thing I can bet you a lot of money on is that we will hit 2,800 before we hit 11,700. So we look to the nearest targets first. We've got this next one of 483. So if we break this one, then I would be starting to look at that one. And if we broke that one, I go, where on earth are we going now? And this is now, of course, a very long-term view. This could take a decade or two to play out. But if, with all that's happening in the world, you know, I kind of feel it, you know, it could happen. And we have to remember from 2003, gold did actually go from like $300 to $1,800. So it did go up sixfold. So it's done it before. So we go back to the 1% chart. There's the 1%. And so now what I want to do is go to the shorter term. I've already done this really with the arithmetic. So I'm going to drop down to 0.5%, 3,071. So we need to break that to a new high to activate that. But it's that massive move that we saw in gold. If we move higher than that, all the gold bulls like me will basically be confirmed. This is the 25 by 3. And you notice, the 0.25% by 3. And you notice now that this chart is getting difficult. So you've got to switch to 60-minute chart. And by switching to the 60-minute chart, we get an interesting picture. We've got a couple of downside targets that weren't met. We've got a trend reversal, 1984. We did talk about 1980 previously. So that will be interesting. No real clues or targets yet taking us higher on that short-term chart. So it's too early to say that we're going to break to new highs imminently. And then I'll go right down to a 0.1% chart. And if you're trading gold, you will drop to, it's requesting the data. There's a lot of data here. It's going to go and get the 1-minute data. But if you're trading gold, you're going to basically look to a 1-minute chart. So if I just grab that 1-minute chart. So this is interesting. If I go to, I just hit the T key here, I've got to basically go to smaller box sizes on that 1-minute data. So we do have 1975 activated. That's near that 1980 level. So I'm getting a lot of information that's starting to tell me. So if you're trading gold, you'd use the 1-minute chart. This is a 1 by 3, and you'd live with all the thrills and spills of what's going on. So US stock markets, that's the one that's probably more interesting for most of us. What's happening? Interestingly, on the charts, we've seen a little bit of a recovery on the clouds. So this is the weekly, daily, 60-minute. Short term, we are seeing a little bit of a recovery. That bearish engulfing candle is really significant on the weekly. That's been hanging over us. We might be finding some cloud support. But the really key thing is that we did activate a downside target. This is the 0.5% chart. We did activate a target. I also put all these key levels on my chart. That's this button here. So it just helps me see the levels. So we do have a downside potential on the S&P 500 of 14%. That first initial sell-off, and then the move to a lower low, that's the Dow theory, confirming that downside target, says we have a downside potential to 13%. It is counter trend still, and we do have an upside still to 24% and 46%, but this could be a warning that we might see a reversal in markets. And that also happened on the 1% chart. By the way, the last few targets are quite often wrong. So, you know, that last target, it may just not be met. You might be negated before it's met. We do have quite good support here, multiple tram lines, if you like. But we do have this 20% downside hanging over us on the 1%. And if we look at the short-term picture, interestingly here, we did have 3 downside targets that were given, and we didn't meet those. So that is inherently bullish. You can't ignore the fact that that is bullish. I don't have a strong view on the market at the moment, but I do know that that target is hanging over us. Not activated on the S&P on the 1%, but if we go to the NASDAQ, where we've seen more volatility, of course, it was activated and we got downside potential here of 22%. Interestingly, the picture has changed a bit on the 0.5%. So we've got 3 upside targets and 1 downside target. And we still do have on the 60% chart a downside target of 6% hanging over us. So it is quite key. Taking a look at the Dow, we have a similar picture. You know, it's no great surprises there. I look at the futures quite a lot, mostly for just what's the US going to do today. And presumably in Oz, most of you are in bed when that's happening, so you're not probably looking at that. Market volatility, do look at the VIX volatility, the fear index, and just again, the targets here. So this is an inverse one, of course, so if the VIX is going up, that's bad for markets. And then you can look at anything else. So let's have a quick look at the Aussie market. Oz is very interesting because this is the ASX 200, fallen away very heavily, big weekly candles in the collapse. We all know the reasons why. As technicians, we don't really care why, but that was very resource laden. And then we've seen the recovery. We haven't really got back into bullish territory. Remembering that the US market was making new highs. But the Aussie market is moving back into short term, but it really has been a sideways market for a good few months. And I guess you don't really need me to tell you that. But what's interesting now is we're on the cusp of hitting some resistance on that trend line. There's a very big downside target of 50%. That seems improbable, and an upside target of some 40%. So it just highlights the uncertainty long-term for markets. You know, COVID has produced this uncertainty, and we've got these big targets in either direction. This is the 0.5% chart. Again, big target downside, little targets the upside, and hitting some resistance. So the Aussie market is not looking great at the moment on those charts. And much the same here. We've got downside targets and 1 upside target. So just that's the picture. Another one I do look at because, as I said, I'm invested in Aussie gold shares. The one I do look at is the Australian gold price. And here, that $4,300 target has actually been activated on the 1% chart. So gold in Aussie dollars is looking a bit better. So I just do look at that as well. But I'm happy to, I've done my hour almost. So I'm happy to take any questions. Hope that wasn't too much detail. As I mentioned, if you email me, I can give you the full sort of course that you could follow and do it at your own leisure.